I said, see how it all works, because numbers are just numbers, right? But how they all work together is what really matters and is what really creates the lifestyle. And so I'm gonna do that tonight, especially since we have a smaller group. It allows us to dive into stuff like this, and so we'll do that. Um, we'll do that, and then at the end, I'll take questions that you might have about just specific scenarios based on what you see with Sherry. Sound good? Hopefully it sounds good, right? So Sherry, what Rose, I appreciate all your great feedback. You keeping me motivated up here. And thanks, Dorian. So Sherry, are you ready? If you're ready, just unmute yourself.
Yes, I think I'm ready.
Okay, cool. And again, there's no right or wrong in any of this stuff. It's all about just helping each other, right? And so Sherry, well, the three things we're going to talk about tonight in all of this is we're going to talk about Fegley. I'm going to knock out Fegley first because it's the easiest. It is the easiest to talk about. And then what we'll do is we'll go into her FERS pension and her Social Security, and then we'll save the TS. We'll talk a little bit about the TSP, but we'll save the TSP to Saturday. So the first thing we're going to talk about is again the Fegley, right? And the Fegley is the FEGLI, which is your Federal Employee Group Life Insurance, right? And so what it is when you start in the federal government, it's the standard issue life insurance that you get, right? And so what I'm gonna do now is I'm gonna share my screen. Oh, first, let me go to the Fegley website first. And so, Sherry, the question
Mhm.
that I have for you is, do you have the Fegley?
Yes, I do.
Okay, cool. Now, what is your roundabout salary? What is it?
149.
Okay. All right. And then what's your current age?
Hey, you woman, don't give her age.
Or what's the
Six-
what's the age range?
That's
What's the
my
age
group
range?
right
Give me the
there.
age. Which one?
60 through 64.
Okay.
That's the group.
Okay. You're paid bi-weekly, right?
Yes.
Okay. And while we're doing this calculator that we're going on, let me put it in the chat for everybody to go through if you want to do it along with us. Okay. And y'all can see my screen, right? Yes.
Yes, I see it.
Okay, cool. And so this is the calculator, the opm.gov calculator. It's the Fegley calculator. Now, Sherry, what do you have option A?
No, I think I have option B, but only one multiple, I believe.
One multiple. Okay.
Mm-hmm.
Do you have option C?
No.
All right. So option A, just for everybody, is $10,000, is just a $10,000 policy. Option B, you're able to get up to 5 times your salary from 1 to 5, right? And so you can run your numbers on it and we'll see where you are. And then family is your kids are covered up to 22 years old, then they come off. And then your spouse is covered up to 25,000 and is in $5,000 multiple. So the most times five is 2,500. It's 5,000 times five gives you that 25. So that's how that works, right? But Sherry doesn't have that, right? So we're gonna go next for you, Sherry. And then that would mean, Sherry, you have $300,000 in life insurance. Okay. You got that?
Got it.
Now that means right now you're paying 83.76 a pay period. You got it?
Right.
Now
Mm-hmm.
the question I ask you, and the question I ask any of you all that are here and you're looking at your own numbers, Sherry, you got 300, you're paying $83 a pay period. Do you need the 300? Is that something that you would like to carry into retirement, or is that just you just have it to have it?
Well, I just have it since I'm working. I mean, I'm still working, but I have some additional outside whole life insurance policies
Good.
where when my plan now, my plan is that when I retire, I will drop this.
Okay. Okay.
That's my plan.
That's your plan to drop it. Okay. 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 And so the 300,000 is just to cover you while you're working, and that's it, right?
Right. Right.
Okay.
But that was kind of my question that, is
Yeah.
do we need, I'm definitely going to reduce it down because I definitely don't need the additional,
Okay.
but is that something that we should carry on once we retire, or is it just individual based upon if you already have some other insurance?
Yeah. So when you say should, is like it just depends on your situation, right? And so in your particular situation, one of the things that we ask clients is all the time is, well, how much do you personally own? And so you obviously already have policies outside, so that's great, right? Because let me show you how it works once you go into retirement. Because right now you're paying the 83.76, and the basic coverage is costing you 24.16, right?
Mhm.
The option B one times this 149 is charging you 59.60. Okay, got that part?
Mhm.
So that's
Mhm.
the
Got
that's the 83.76 total that you're paying.
right.
When you go down here, option B additional, every 5 years this is going up. So when you turn 65, this is going to jump to 71, right?
Okay. That's what. Okay. Okay.
Yeah. Now the next
That's
thing,
why I wanted to drop it.
right? And then so let's say in retirement, and this again goes for everybody, right? When you go to retire, you're going to get three options when it comes to your FEGLI. You're going to get the 75% reduction amount and option, and that's pretty the standard option, right? Where the is going to reduce down by 75%, but it'll be free. So I'm gonna do this for Sherry so she can see. And so
Mm.
Sherry, when is your ideal retirement age?
66.
Okay, so we'll leave that there. And then you're not going to keep option B, right?
Right.
All right. So if you go and you say calculate coverage following retirement, you put the 75% reduction, you leave option B at 0, and you put your retirement age into the calculator, then now you're looking at, if you look at the summary report, the coverage amount you'll be left with, and it'll be free, right? If you see here, monthly cost
Mm-hmm.
after age 65, $0. You're receiving,
Mm-hmm.
you'll get a check of, you're after the final reduction, your family will get $37,000 in coverage. You got that?
Mm-hmm. Okay. And I wouldn't, nothing would be coming out of my annuity
No,
check. Okay.
nothing to be
Retirement
coming
check.
out, right? But this is how much coverage. So you have 300 now, but when you let it all reduce down, it'd be 37. Okay.
Okay.
Because
Okay.
that's 25% of whatever your pay is. But now
Okay.
let's go back, right? So let's say you were the type, and please do this on your own for your own numbers, that say you wanted to keep the cover. Say you're like, Mrs. Smith, I want to keep I want to keep 300,000, right? So that was your scenario,
Mm-hmm.
right? If you were to keep that 300, you see the cost. So you would be able to keep the 151, but the cost after retirement will be 339. You see that?
Mm-hmm.
That's just for that 151. But then the other amount that you have, that one times B, that would be 140, 145, 154, in addition to this 339. You got that?
Mm-hmm.
And so this is the
Okay.
reason, just for everybody, this is the reason why, when it comes to the FEGLI, you want to, sort of like how Sherry already has, it's like you want to have some level of coverage outside of the government, because if you have coverage outside of the government, it allows you to fix your costs and not have to be subject to these consistent increases in costs, because even that 154 keeps going up, right? And so that's how the FEGLI works, right? And so just giving her another example from Sherry, just using her numbers, if she had the 5 times her salary, let's just go to that because a lot of people default to that. If she had the 5 times her salary, she would have 896,000 in coverage, but she would be paying $322 a pay period at her age. Y'all see that? And
Yep.
so then, and then if we go down to when she retires, if she was to keep that amount, the 151, that'll stay the same, that 339. But this option B will be costing her $774 a month.
Mm.
You get it? And so that's why when we do these retirement sessions, we always encourage people, the younger you are, it's best to try to get a policy that you personally own, because you're not subject to these increases in costs. Because with the FEGLI, it stands for the Federal Employee Group Life Insurance Policy. And so with the FEGLI, the G is the key. It's group, right? And so because it's group, you're paying the same cost as the person who might not be in the best health, right? And it works for that person, but for you, if you have average or better health, you save lots and lots of money by having your own private policy. The earlier you get, so you're not subject to this. You can just let the basic drop down to 25% of your salary. It's free, and you just live your life, and you have coverage going into retirement. I'm gonna stop there for questions around this. Because I want, before we go into the FERS and Social Security, I want to make sure that, does anybody have questions about this in particular? If you do, just unmute yourself so that I can answer those questions. Anybody?
Yes, I have a question. Can you hear me?
Yeah, who am I speaking with?
My name is Jennifer.
What's up, Jennifer?
All right. So basically, I personally myself didn't buy into FEGLI at all.
Okay.
But I know the government give you a basic coverage that you're not paying for, correct?
No, they give you
No.
so you don't pay for it in retirement, but the basic coverage, just going back to Sherry's example, the basic is this is her basic right here. This is her salary. Mm-hmm. This is her basic, right? Well, they round up by 2,000. So her salary's here, but they round up by 2 for the basic. And so the basic it doesn't cost you much while you're working, but it costs you a bunch in retirement. So this 24 jumps to $339 once she retires, if she wants to keep it.
Understand.
So it's not, well, hold up. No, it is. What agency do you work for?
I work for the post office.
Oh, yeah, it is free for you. I'm sorry. It is free for the post office. It's free for the post office. It's free while you're working. But when you retire, though, it jumps up to that, in this example, to 339, that big amount. So yeah, sorry. Post office is free. That's why on the calculator you see here, which says, "Are you a postal employee?" Yes. If we did that for Sherry, then you see it just becomes free. You see?
Okay. But like you said,
it's not. Yeah.
It's not free. So when you retire, you don't have to get it, right? It's if I retire tomorrow and I don't have FEGLI, I'm good.
It depends. Right? It depends. It's good if you have something, if you don't need life insurance. Now, if you're the person that says, yeah, I got FEGLI, I got $100,000 in FEGLI coverage, and I want to continue to have $100,000 in life insurance when I retire, then it's not good. But if you're the person that's like, I got 100,000 now, and when I retire, I don't need anything but 20,000, then and I need more than 20,000. Well, if you say I don't need nothing but 20,000, then it's good. Does that make sense? Because your life insurance is going to decrease dramatically when you retire. So, so the best thing to do is to get a private policy or build your TSP up in a way that you don't need life insurance. That's the solution for you in that case.
Got it. Okay.
Yep.
Thank you.
You're welcome. Anybody else have a question on this on FEGLI? before we move on? Nobody? All right, just looking to see if any hands is raised. Okay. All right. So the next thing we'll do is we'll go here, right? And so when it comes to your retirement, you're going to get it's going to be what they call a three-legged stool, right? And your three-legged stool is going to be your FERS pension. That's made up. Well, before I go to, is there any civil service people on here? It's less and less civil service people working anymore, but I'm assuming there's no civil service. Okay, so if we're all FERS, then you're going to get your FERS pension, which is made up of your high 3 salary and the amount of years you work, right? That's your high 3 salary. And I'm going to go into the formula in a second when I calculate Sherry's, right? But so you have your FERS pension, and you also have your Social Security, right? And if you're 57 and have 30 years of service, you're going to get your FERS supplement, which is basically early Social Security, right? But you have to be 57 and have 30 years of service, or 62 and have 20 years of service. So that's what allowed, if you remember Laura yesterday, Laura was able to retire early mainly because she's getting her FERS supplement, which allows her to get her FERS pension, but she's also getting a portion of her Social Security early, and that's enough income for her, right? And so that's that. And then the third leg of that stool is your TSP, which is obviously your thrift savings plan, right? And so when you, as a federal employee, you're going to get 3 checks, or have the potential to get 3 checks if you take money from your TSP as income. So with Sherry, I'm going to build out her process just again here, just so you can see how all of those income streams flow together. So Sherry, what is your birthday?
10/9/60.
Okay. All right. And what state do you want to retire in?
Florida.
All right. So this is a big deal too, and while numbers don't stand alone, because obviously the taxes in Florida are different from the taxes in Maryland, or the taxes in Virginia, different places like that. So, this is why I wanted to do this like this, because taxes are a big part of your retirement, and I want you all to be able to see that, because again, just raw numbers isn't that helpful. Because taxes are going to affect it in a big way. And with Sherry having a retirement state being Florida, obviously she's not going to be paying income taxes. So that's going to help increase her retirement in a big way over people that live in other states that tax on income, right? And this system will give us that tax data, because we selected her retirement state as Florida. So I'm not going to go to the beneficiary and all that stuff. I'm going to skip over that stuff. But I'm going to go here, and now we're going to get ready to calculate Sherry's pension. And as I calculate Sherry's pension, I'm also going to teach you how to calculate your own pension, right? So, Sherry, you said your income was 149, right?
Mm-hmm.
All right. And then when do you want to retire?
Yesterday. Okay. It'd probably be December of 26.
Okay, December 26th. Okay.
Mm-hmm.
All right. All right. And then Sherry, what's your service comp date?
3/21. 21. Oh my goodness. 89.
All right. So, okay. So Sherry been in the government
91. I'm sorry, 91.
91. Okay.
91.
So for everybody else, right, your service comp date is the date you started in the government, in case you didn't know that, right? And it's what the government's going to use to create your FERS pension, right? And so with Sherry, right, and we're just going to do a rough estimate. We have a more systematic way of doing this in-house, but just to give you a way of doing this on your own, here's how we're going to do it, right? So with Sherry retiring in 2 years, her salary right now is at 149. She's retiring in 3 years. So we could just use this as her high three. She'll get raises, but let's just say it averages out to 149. Because they're gonna take, they're gonna take the average, right? So what we'll first do is we'll figure out if she started in 1991, we'll take her 2026 ideal retirement date, minus it by 1991. That will give her 35 years of service at that point. Okay. And you could do the same. So you take your you would take your SCD date. Well, you would take the ideal year you want to retire, minus it by your expected retirement date, right? And it'll give you your years of service, right? And so then what you do is you take that number, and then you times that times your high three estimated salary, right? In her case, we'll just use 149. Right. And because Sherry is above the age of 62 and she has over 20 years of service, we'll be able to times 1.1%. Okay. And when we do that, this is the number we'll get. So this will be her annual salary that she'll get as far as her FERS pension. And so when we do that, that will give us 4780. Got it? And so what we will do is that we could then put this down here as her FERS pension estimate, right? And then that will give us a gross, because we still haven't taken the taxes out, but it'll give us a gross pension of 4780. Okay. And then we know her start date of when she wants to retire is at 10/6. So she'll be 66 years old at that point, right? That's when you want to do it, at 66, right?
Right.
Okay. So now we have her FERS pension, which is one element of the three-legged stool. One leg of the three-legged stool. We have that calculated. Now the next leg is her Social Security. So this one, you can go to ssa.gov. If you don't know your numbers, you should get the statements in the mail. But if you don't know it, you can go to ssa.gov's website. Here it is right here. Check your benefits. Go through this process. They say it takes 10 minutes or less. You'll be able to get your SSI numbers, right? And so that way you're able to calculate this and get an accurate amount of what you're able to put here, right? And so for Sherry, because I knew I was going to use an example, I asked her to do this ahead of time. And so she gave me, just so we don't waste time doing it, so she gave me her numbers. And so Sherry, you said you wanted to take it at 67, right? At your
right, it's 67. Mm-hmm. That's my full retirement age.
Yeah. And so that number was that 2939. Oh, sorry. 2935. Sorry. Can't read my whole handwriting. Okay. So we were able to, this is her, she and Sherry wants to wait to take her Social Security 1 year, right? So for 1 year, Sherry will receive only her pension and her TSP. So we got to create a whole plan around that. We won't do that today, but that's just something you have to think about when you just say you're going to retire at 66, but then you're going to wait 1 year to be able to take Social Security. Does that make sense? And sure,
yeah,
you're aware of that, right?
Yeah, okay, I'm aware of that. Yes.
Okay.
Yes. Now, I did have a question about when you did that, and so it came to 4708, I think, or something like that for my pension. Right. Now, but that doesn't take into account, like, if I was going to have an additional with the FEGLI and my health and dental, that still has to be deducted from that 4708, right?
Yeah, I'm gonna get into that, right?
Okay. I
But
just want to make sure.
one point I want to make, right? And because a lot of people say I want to wait till they're 67 to 67, right? But here's the if you look at your social security statement, you will see this. This is like once I put in your full retirement age, the system is able to calculate what it will be at each age going backwards. And so if you see this, by waiting 1 year, you're gaining about $200 extra per month for the rest of your life, right? That's,
Mhm.
you know, and so one of the things that we help you make the decision on is that worth it, right? Because you're going to go through a year of way less money, $2,000 per month less, just to gain $200 extra per month for the rest of your life, right? And so, that's just a decision that you can make. Because a lot of times people say, "Well, I'll ask you, what made you say 67 instead of 66?"
Well, because that is the full retirement, but not. But my actual plan is, I really want to wait till I'm 70
Okay,
because there is such a drastic difference. And I
right,
felt that with having my pension, my federal pension, then what I had from TSP, that and I still plan to do some type of consulting or something, a little part-time stuff. And I felt like I would still be able to, I would be okay. And I really wanted to wait till 70.
okay, and that's and
So
that,
I'm just kind of seeing year to year how if my health stays well and all that kind of stuff.
right, and so obviously, we'll help you make this decision. But I just wanted to, a lot of times people make this decision and they're not looking at
Mm,
the real numbers, right? From 66,
mm,
because you said 67. So that's a
right.
$200 decision. But is it
Yeah.
worth the stress of a year of, you know,
Hmm.
trying to figure it all out, right? And there's a lot of
Yeah,
different
I
ways,
get it.
there's a lot of different ways to solve for that money, even the 70 to, with your TSP. But I really wanted to show everybody that because a lot of times people, have the preconceived notion of like, oh, yeah, I'm just going to wait. But then you got to realize, is it worth the stress, right? Is it worth
Mm,
the stress of waiting? You didn't work your whole life, right? You're going to make less money. Most people make less money when they retire. Well, I'll put yourself in even more of a handicap because you're trying to, going back to the mindset piece where you can't really enjoy life because you're waiting for this future time where you're able to, make $200 more or $300 more. Like, is that really worth the stress of not
mhm.
having 2,000 a month now to get $300 a month more a year or 2 years from now? And so, um, I'm gonna keep pausing because I know me, you, Sherry, have been talking a lot. Does anybody have any questions about this, like the FERS pension and what we've talked about so far with Social Security? Because we talked a lot about stuff. I want to make sure that we don't get lost in too much data, so to speak. Any questions about this? Um, okay. So, all right. So that means I guess Sherry, we're doing a good job. Um, so now once we have these, this is the first two legs of your three-legged stool. I won't go into your TSP tonight. So, and well, I'll briefly touch about it, but I'm not going to ask you about your TSP. But like what we would add here is her TSP, right? And once we add the TSP, that'll give you your spendable assets. That's money that you can spend however you want it. You can take cash flows from it. That'll make the difference, right? But what I want to do here first is like, Sherry, if you just give me an estimate of what you think your monthly expenses are. I don't want to go through all this with you. We do go through this with everybody when we meet one-on-one, but I just want to show them how the three-legged stools work. If you just, what's the estimate of what all your monthly bills are put together? If you had to estimate.
Um, at 3,200 a
All right,
month.
let's say 3,200. All right, so now we got your monthly bills in there, 3,200. One of the things that we always take into account when it comes to things is inflation, right? So if you have to take into account inflation, because the cost of, like, again, the cost of groceries, 10 years ago, $100 could get you almost a week, 2 weeks worth of groceries 10 years ago. But now, groceries, $100 in groceries might get you one and two meals. You know what I mean? So we got to take into account inflation, because again, what you pay for things now will be different in the future. And so, just to give you a preview, like, we go through all of that. Like, we go through what your mortgage and stuff is, house cleaning, lawn care, all these different things, utilities, food, groceries. We take you through all of this stuff, so that you can see what it's going to look like in retirement. Because again, we don't want you to have any type of surprises, right? And you don't want to have surprises. And so, you get your first pension numbers, you get your Social Security numbers, and then, like, but what does that mean if it's not tied to your expenses? And so, sure, you mentioned earlier about like health insurance. So like, we would add this stuff in there. And so then once we have it in there, we will also look at your taxes. These are your federal taxes, not your state taxes, right? Because you're protected. Florida state taxes are at 0, right? But when we go to retirement, well, hold on. Fix this for you. Okay. So when we look at this here, what this says right here, based on her first two legs, which is her pension plus her Social Security, after taxes, she's down to 7,111, mainly because she lives in Florida. But her net monthly cash flow after her expenses is around $3,000, which means she's cash flow positive around $3,000. So in this case, and again, we're looking at raw numbers. We don't really know her expenses, because typically people, what they say is a lot more, than what they say. But just looking at this from a raw perspective, it means she has $3,000 extra every month that she has, right? And so I wanted to show this because your three-legged stools, they stand, but if once we add in your TSP, that becomes your spendable asset. That's why you see that at 0 there. But you want to take into account your taxes, and then net after expenses. This is her expenses, and then this is what she has net left over. Now, everybody's situation is different. Her situation, this is not a real complete situation, but I wanted to show y'all this tonight because, again, the three-legged stool, if you're looking at gross numbers, it can be kind of confusing, or you can go to retire and then you realize, like, wait a second, why am I having less money right now? Is because you never accounted for the things like taxes and inflation. So, like, even if you look at her expenses, if you see, she said 3,500, but every year they're going up. And again, we get more detail, but like, inflation is what's causing it to go up, right? And so, again, when you look at your three-legged stool, they're great, but you got to look at all this other stuff too. And so I'm gonna pause right there for questions, because I know, like I said, I know this, it's not like last night. These are like real numbers, like really in the weeds. It might not be as exciting, but it's really important stuff. And so I want to make sure that you all, if you have any questions, I want to make sure I can answer them around this. You have any questions about this? Or your situation? Rose, you have a question?
Well, this was very straightforward. You explained it very well. Be honest with you, I thought that I would be getting a lot less. But the young lady that spoke last night, she said that actually, when you calculate it, it really isn't that much less, if you prepare for it.
Right.
So this is really good. I guess I just lost my way in reference to that, to the first thing you was talking about, but this made perfect sense. I just wanted to say thank you very much.
Let me build on that for you, why that is, right? And so the reason why that is I didn't build this in for Sherry, but like I'll just put in some, I don't want to go into her TSP or anything like that. But like, let's say she had, 450,000 in her TSP. Let's say she had 450 in her TSP. This is why Laura was saying that. And this is what people miss often. Sorry. All right. So let's say she had 450,000 in there. And let's say she was putting 10% in. If her salary is at 149, she's putting 10% in. That means per month, she's putting in $1,241, right? Per month. Oops. So that's how much she's contributing to her TSP. But then when she retires, she's no longer contributing that amount. Not only that, if we go to her taxes, right now she's working, but when she retires, so like right now she's in the 24% tax bracket, which means federal government is taking 24% of her income. When she retires, it drops down to 22%. So she's no longer paying the 24, she's paying the 22. So that saves some money. Then she's no longer putting $1,200 a month into her TSP. That saves her money. She's no longer paying for FEGLI option B. That saves her money. You see what I'm saying? So like all those costs that are being cut is what's saving her the money. And that's what Laura was talking about. So like Laura was putting a bunch in her TSP. She's no longer doing that. So now, she didn't shaved off almost $2,000 a month in income by just retiring because her taxes are lower. She's paying less to her, no longer doing the TSP. Her lifestyle's different. She's not doing as much as far as like going to work and stuff. And so that's what she was like, you know what, at the end of the month, I got close to, almost more in my bank account because of that.
Okay.
Yeah. So that's why it's important to run your numbers, because you just working blindly if you don't have a plan. Like, and I say that because, like I said last night, I know people that have $1 million in their TSP that in 15 years, they're based on what they're doing, they'll run out of money, right? Because they got expenses that are $8,500 a month, and I have other clients who, they got, 100,000 in their TSP, but they don't care because their expenses are real low. The house is already paid off. And they're like, all right, I'm cool. I don't really need this TSP. I'm good with, going back to even Sherry, like if these were real numbers, she's with these two income streams, she's positive $3,400 a month. So she doesn't really need her TSP for income. You see them? She doesn't. Based on this example, again, I don't know if this is real expenses, but based on that, she's okay. So it doesn't really even matter what she has in her TSP for real, because she's cash flow positive. Now we could talk about long-term care and all the other stuff, but like this is an example of a scenario in which her first two legs takes care of her expenses. And that's really where you want to be, is where your first two legs are more than your expenses, and you don't really need your TSP for your day-to-day living. That's a solid retirement if you can do that, because then what it allows you to do, it allows you to grow your TSP and then use your TSP for fun stuff. And even in her situation, she can use her extra income for fun stuff. But that's why no situation is the same. And that's why when people say, well, what's the ideal amount to have in my TSP? There's no real number to that. It's more so, how are you doing with your expenses? That's really the conversation. Is how are you doing with your expenses? Is the real question. And then we can figure out the TSP later. But okay, going back to Sherry, let's say this example is real. She wanted to wait a year to take her Social Security. You know, you see here that first year, she's cash flow positive about $500 per month. This year is more now because now she's taking her pension. I mean her Social Security. So now this so she could still do it. She's like, is razor thin as far as her margins are concerned. But then this next year, this net monthly cash flow kicks up because now she's taking that SSI. So she can do it based on this raw example. And like, this is how we kind of walk people through it when we do a session. But, any questions? I know I'm talking a lot about numbers. I want to make sure that, okay, somebody put a question in the chat. My easiest retirement calculator, I can see my number. I hope they retire in about 7 years. I think the numbers look good, but who knows how much it will change with things like tax and health insurance. And what's your name, H. Thompson? I'm sorry.
It's Helena.
Talina, okay. So Talina, yeah, you're right. When you run those calculators at work, they're great, right? And again, like we've done this presentation before, we just run those numbers. But the thing it leaves out are things like what state you're living in, right? And so, because what state you live in, it determines the taxes. And so that's why you want to run your numbers in like more of an official way, because you can see the real tax. Like, just for example, in this case, right? So Florida, taxes withheld 700. But if we move this to another state.
Georgia.
Georgia. Okay. So Georgia doesn't tax Social Security, which is great. But so let's do Georgia.
So does Florida tax Social Security, or they just don't have state tax?
State tax.
They just don't have state tax. So which states don't tax your Social Security and they don't have state tax?
Hold on, I'll get a list.
That's where I'm trying to go.
I'll give you a list. So hold on.
I thought Maryland was one of the ones that didn't tax Social Security. Or am I wrong about that?
I think you're wrong about that. So hold on. Here, so you see how the taxes, when it didn't go up by much, again, because Georgia doesn't tax Social Security, but it still went from $711 to $955 per month. So that's $200 extra per month that it went up just because of taxes. See that?
Okay.
So like that's why, say your name again, Ms. Thompson. I'm sorry.
It's Helena.
Helena. All right. Helena. All right. But this is why, taxes matter depending on what state you're in, right? When it comes to running those numbers. And then when you also mentioned health insurance, I mean, health insurance it just changes based on the plan you pick, the time, what year it is, and what inflation is a big thing with that. Like, inflation in the healthcare space is higher than normal inflation. Like the cost of healthcare is going up higher than regular inflation, right? And so this is why having a plan and making sure your money's growing in a way that outpaces inflation is so important. And this is why if you just have all your money sitting in the G fund, is kind of dangerous, because you're only getting 2%, but the cost of things, especially like healthcare, which is going to be your biggest expense in retirement, those things are going up a lot faster than that. And so you want to make sure your money is growing in a way that's outpacing that. And so it's a very personal situation when it comes to retirement planning. And so you just want to make sure you have your retirement plan in a personalized way. And so when you look at like calculators and things like that, they're good for general information, but just know it's a lot more to retirement than just those raw numbers. Anything else around that, Helena?
No, not really. I mean, I think it's good to have the calculators and do the assessments probably yearly to get your numbers and things like that.
100%. And that's what we recommend. I mean, that's what Laura did from last night. Like, you just want to make sure you're constantly looking at things because things change. Like, you move, you sell houses, people might pass, you might get inheritance, it's all types of stuff. Medical things come up. You just want to know what your situation is because it's really important. But that was a great question. Rose, do you have another question? And it's fine if you
Yeah, I
do.
do.
Okay,
I
go
do have
ahead.
another question. So I read something the other day and I forgot to write it down to ask you, but it said to me it was around FEHB being suspended or canceled or something like that. Have you heard anything about our health insurance being canceled next year or something
Anybody
of
else
that
have
nature?
news on that? I don't know about that.
Well, you
Yeah.
know what? I'm gonna go back and read it and forward it to you.
I mean, that seems like
'Cause
that'd
I'm
be
like that
it.
that that
I mean, you mean
cannot
what
be done.
if there's a what you call it? Not a strike. What they call it?
Like
Government
furlough.
shutdown. Yeah,
A
If there's a
government.
furlough.
furlough.
No. So this didn't have anything to do with the furlough. This was around, like we're in open season now, and I'll find it because I just saw it the other day. I'll find it and forward it
Yeah,
to you
I don't know
when.
anything about that, unfortunately.
I
Sorry.
was on a call from work today. I think it was a situation where some of the carriers have dropped off of FEHB, so they're supposed to provide notification to people that they need to sign up to another
Oh, okay.
insurance provider. But a
And
lot
that
of
may be
them
the
apparently
case.
dropped off.
That might be the case because this year more than ever, I've seen people talk about like switching their healthcare. And again, that's not our area expertise, the health insurance side, honestly. But like, I have seen a lot more conversation around that, so that could be the case.
I mean, I just don't want to miss out again, like I did on the long-term care. It
Yeah,
it announced it for you. It announced it for months, and then you kept trying to remind us to, take action, take action, take action. And I just kept thinking, I'll do it tomorrow, I'll do it next week. And of course, before you knew it, it was too late, for the
yeah,
long-term care.
yeah. But again, I mean, even with that, like you could plan around that. Like if you got the right amount of money in your TSP, and
Yeah,
this again is why having a plan is good. So like if you
right.
have like just for this example, right? I put I put 450,000. She's putting 1,200 a month away. I didn't even put the match or anything like that. But like, if this money's just sitting there, this money is growing, right? And
Right.
oftentimes people become TSP millionaires once they retire because their TSP money is just growing. And so in this case, if your TSP money is just growing, you have a long-term care issue, you have enough money to take care of a long-term care situation. And so you don't necessarily need to have a long-term care policy if you have enough money in your TSP.
Well,
And
yeah,
you
yeah,
and
yeah.
so that's some of the things that we help people with. But like again, every situation is personal, right? You don't have to go spend money on long-term care. You can fund it yourself if you have
Right.
the amount of money in your TSP. It's all about planning properly.
True,
Um,
true.
and so yeah. So any other questions? We got about 4 more minutes. I want to make sure answer these questions around those first two legs, or anything we talked about yesterday.
I have a quick question.
Okay, go ahead.
Um,
Who am I speaking with?
what? This is Jennifer again with the
What's up,
post
Jennifer?
office. What if you've been putting money or in a high yield savings account? Is that something you recommend? This is something that you do on a side in addition to your TSP and other little things like that. Is that something you recommend?
I mean, it's not a bad thing. I mean, so like, it's not. I mean, I don't know enough about your situation to say it's a good or a bad thing. I mean, but like, just just like what Laura was saying yesterday, when you do retire, there's going to be a gap in when you receive your first check, right? And
Mm-hmm.
so if you put money aside and it's emergency money, that's not a bad thing because you're going to need that when you go to retire. Or if something happens, putting money into a high yield savings account is a good thing. But if you're not putting a lot of, if you're not putting, let's say, and it's different for everybody. So, but let's say you're not doing the 5% towards your TSP, and you don't have a lot in your TSP, and you're putting more money or just as the same amount of money in that high yield savings account, as you are your TSP, that's a problem, because you should be putting more money towards your TSP, because your TSP is going to be what's going to be there for you when you retire, and it's typically going to grow higher than a high yield savings account. The reason why high yield savings accounts are high right now is because interest rates are high. But typically, a high yield savings rate account is only going to give you 1-2%. And so you can get more return by having that money in your TSP. And there's different strategies around that. So I don't know if that answers your question. But even still, when we're building our plans, we just add that account here, and it goes under your spendable assets, and it builds up your overall. So you can still see that, like, that can be included in your financial plan around what you have in all your savings accounts. That way we can look at the whole picture when you're building it out. That's something you want to do.
Okay, thank you.
Yeah. Any other questions?
I have a question.
All right, who am I speaking with?
Speaking with Burrow.
Burrow, what's up, Burrow? What's up, man?
Hey, how you doing?
I'm doing good, man.
Yeah. You mentioned something earlier about the at the end, when you retire, they take the last 3 years of your salary and give you the average of it. Does that matter how many years that you worked? Because I got into the government late compared to everyone else on the phone call.
No, it doesn't matter. It's always the high 3.
Okay.
Yeah.
All right. Thank you.
Yep, no problem. So that our next session, we won't have a session tomorrow. We'll have a session Saturday morning at 10. I'll send an invite out. And that one is going to be all about TSP, right? We're going to go over the TSP funds. We'll go over how people take distributions from their TSP. We'll talk about IRAs and things like that, annuities, things like that. And then we'll also share with y'all. I'll also share with y'all a concept that we use was called the financial house. And we've been using this for years. We've been helping federal employees for over a decade now retire, and with the whole goal of making sure you don't run out of money, and that anything that you run into in retirement, you're able to withstand it, right? And so we'll show you how to build your own personal financial house so that you can retire with peace of mind. So I'm wishing everybody the best. Thank y'all for showing up. I know this was one where we were just in the weeds a bit, but there's no way to explain this type of information without showing like a real example. And Sherry, I really, really appreciate you for allowing us to use you in this way today by being an example. So I really, really appreciate you for that.
You're welcome.
Yep. And so wish you all a good night, and I'll see y'all on Saturday. All right.
Bye-bye.
All right, everybody.
Bye-bye.